Thank you for joining me. I'm Gord Long. A reminder before we begin, do not trade from any of these slides. They are commentary for educational and discussion purposes only. Always consult a professional financial advisor before making any investment decisions. When a market starts to conclude that a recession is near, what does it do? Often earnings are still good and only later seem to have been near their peak. What the market starts doing is actually discounting future earnings. This is difficult to assess since as to how deep and long a recession will be is still very much unknown. Growth will go down, but by how much? For a very long time, we have not witnessed a recession led by a major rise in inflation. In this case, the discounted cash flow of future earnings is somewhat easier to assess, at least based on current inflation and inflation expectations. This is the case today. Many see a recession with high inflation. This normally results in larger than normal PE compressions. Therefore, I want to explore PE compressions in this month's LONGWave. As such, I want to discuss the subjects listed here. Let's start with what might be the timeline for a possible recession. Heading into the first estimates of Q1 GDP, estimates were low, certainly far lower than the 6.9% final Q4 GDP number, the strongest since the third quarter of 2020. Commenting ahead of the print, Bloomberg said that, and I quote, "A slowdown in the first quarter will prove temporary, a consequence of Omicron and the drag from volatile inventories and trade," end of quote. Maybe. But what if it's not temporary, like inflation was supposed to be, according to the Federal Reserve, who espoused that nonsense for close to 14 months as inflation only kept getting worse? Maybe more importantly, just how big of a slowdown might we see? We've been told by the Bureau of Economic Analysis that the Q1 estimates for the U.S. economy unexpectedly shrank by 1.4%, the first decline since the COVID summer of 2020. Annualized GDP plunged from 6.9% growth in Q4 to an unexpected negative 1.43 shrinkage in Q1. According to the BEA, the first quarter decrease in real GDP reflected decreases in inventory investment, exports, federal government spending, and state and local government spending, while imports, which are a subtraction in the calculation of GDP, increased. Consumer spending, business investment, and housing investment increased. But let's consider the trade balance with the rest of the world specifically that they mentioned. The world collapsed to its largest deficit ever in March. Imports rose 10.3% in March to approximately $351 billion from $318 billion. Exports rose 5.6% in March to $241 billion from $229 billion in February. The gap in goods and services trade grew by 22.3% to approximately $110 billion, at least according to what the Commerce Department data showed. This was even worse than the median estimate in a Bloomberg survey of economists, which called for a $107 billion deficit. What we need to understand is that net exports subtracted a whopping 3.2 percentage points from the GDP. What we need to not forget going forward is that the U.S. GDP may marginally improve in Q2 because U.S. exports are highly likely to be curtailed by Chinese COVID lockdowns and port closures. This could possibly give the U.S. GDP a marginally positive but weak GDP print. Since a recession is labeled as 2 consecutive quarters of negative growth, we could see negative GDP in Q3 and Q4, and therefore the recession will be considered as starting in Q1 2023. This is what analysts are calling for. But in economic reality and not academic jargon, we will be effectively in a recession in 2022 with slow growth and high inflation. This chart really depicts the reality properly. However, it may be too conservative. According to Mohammed El-Arian at Allianz, and one of the best, in my mind, market economists in the world, and I quote him, "The mess we're seeing in the market is about liquidity. I'm willing to put my neck out and say we have mostly priced in interest rate risk. What we haven't priced is liquidity risk. We haven't priced credit risk. We haven't priced market functioning risk. We're still in the process of pricing it in. The days of abundant and predictable liquidity are gone." End of quote. We won't spend a lot of time on warning indicators like this we are witnessing in the last couple of weeks, but we have seen the Purchasing Managers Index, the PMI, fall and is now approaching contraction levels. The U.S. productivity just posted the worst numbers since 1947, driving up labor costs. The consumer credit numbers were shocking and showed everyone has maxed out their credit card, and this is before a looming recession. Meanwhile, the personal savings rate has also plummeted as disposable income is pressured by surging inflation in food, gas, and consumer goods, leaving no room for expanding demand consumption to overpower another supply shock as occurred during the post-COVID recovery. What we also need to focus on is that we could already be in the midst of stagflation, but not yet be in an academically defined recession, though I believe a recession is a foregone conclusion. It is how monetary and fiscal policies address stagflation which will determine the depth of the recession and its duration. Frankly, I believe there are major concerns in both the area of monetary and fiscal policy, but we'll leave that for another day. The problem here is twofold: the global stagflation concern and a unique U.S. stagflation concern. Stagflation, as you are no doubt aware, is about having slowing economic growth in parallel with high inflation. It is a killer problem for policy planners and the public. The stagflationary shock of 2022 is truly global, with diverging growth and inflation expectations across most countries, with many different factors exacerbating the trend in a synchronized way. Even without gas shortages, growth in the Eurozone slowed to just 0.2% in the first quarter, while inflation rose to a record high of 7.5%. This will be a year of stagflation in the Eurozone, at least according to the chief European economist at Capital Economics. I quote him also: higher energy prices will keep inflation elevated, squeeze household incomes, and dent business confidence. Germany is among the hardest hit, with its energy-intensive large manufacturing sector and export-oriented economy. Over the past 6 months, economists have halved their 2022 economic growth for Germany, while inflation expectations are 3 times higher. The IMF recently downgraded their forecast for 143 economies this year, accounting for 86% of global gross domestic product. In economic terms, growth is down and inflation is up, according to IMF's managing director. And they also go on to say that in human terms, people's incomes are down and hardship is up. The consensus is now for global economic growth to average only 3.3% this year, down from 4.1% that was expected only here recently in January before the war. Global inflation is forecast at 6.2%, 2.25 percentage points higher than in January's forecast. The U.S. is experiencing stagflation, with inflation at 40-year highs, while GDP for Q1 has gone negative. U.S. inflation is higher than overall global inflation, while GDP is comparable to global GDP, but this is misleading. I don't want to cover what I laid out in last month's LONGWave regarding stagflation, but as a reminder, the way to visualize what is occurring is to think of stagflation as a potential black hole. It is easy to unwittingly and unsuspectingly get into, but extremely, if not impossible, to get out once trapped in it. The secret is to avoid it with sound economic policies before you reach what I'll refer to as the event horizon. Many knowledgeable money managers perceive we are potentially entering such a situation. The reaction by central bankers and those in control of monetary policy is to apply traditional Keynesian thinking to the problem. But in this case, it doesn't work. What must be done to control inflation crushes growth. What must be done to foster growth inflames inflation. It is the proverbial catch-22. The solution, therefore, is you must identify it early and act aggressively. The hidden problem in the U.S. is that the distortions and reporting games we've been playing for a very long time have allowed us to get much too deep in the black hole, more than we understand, because our measures have failed to alert us of the realities of the situation. The political kick-the-can-down-the-road policy approaches have only fostered tweaking the warning measures to buy time and make it someone else's problem. Let me be specific. Inflation through statistical distortions, such as hedonics, substitutions, imputation, and other methods, which I have previously chronicled, have distorted inflation as measured by the CPI to such a degree that inflation break-evens, and real rates are effectively useless measures. I most recently laid out how the new world of inflation swaps has exploded in an attempt to protect the more sophisticated institutional investors from these mirrors and mirages. Economic growth is also seriously distorted by an obsolete formula that is based on sound money and adopted during the era of the gold standard and fails miserably to adequately describe real growth in an era of massive growth, debt, transfer payments, and debt finance consumption now being nearly 70% of the economy. The creators of this simple formula never imagined an economy like the one we operate in today. So what does all this tell us about the market and future stock prices? Slowing economic GDP growth when markets are highly elevated relative to GDP is not a good sign for future stock prices. Earnings can be expected to weaken, placing downward pressures on stock prices and PE ratios. But there is more to that PE ratio than just current earnings. PE ratios also move on inflation. That is because earnings are about the future discounted cash flows, or DCF, and the key words here are discounted and cash flows, and really a hidden word called free. DCS is a calculation of companies' current and future available cash, designated as free cash flow, determined as operating profit, depreciation, amortization, minus capital and operational expenses and taxes. Discounted free cash flow is the metric used by investors to determine the future value of investment based on the future cash flows. For example, if an investor buys a stock today, in 10 years they hope it will sell for more than what it is worth today. With inflation exploding, PE should be expected to fall or compress. Consider the problem. A PE of 12 is expected earnings of 8.3%. A PE of 30 is an expected earnings of 3.3%. The higher the PE, the poorer the earnings expectations, or earnings are expected to expand, or possibly they're that high because earnings are expected to expand at exponential rates. This comes into question when economies are expected to slow, or when inflation increases significantly, that is, affecting the DCF, or when interest on companies' debt rises. We have all three. P's can be expected, therefore, to compress considerably in 2022. Now we get to the real problem. It isn't just that the P's can be expected to compress from high valuation levels relative to economic growth, rising inflation, and rising interest rates, but the markets have risen through the domination of 8 key stocks. These stocks over the last few years have dominated the stock indexes and a large percentage of ETF holdings. I refer to them as simply the FANGs, but that acronym has changed slightly over time. They consist of the following stocks that are shown here: Facebook, Apple, Amazon, Netflix, Google, Tesla, Microsoft, and NVIDIA. This year-end chart illustrates the fundamentals of the top 25 SPX companies. Note the PE ratios highlighted by the red box. They averaged 53.3, and with their PEs already down 45%. With last week's disappointing earnings, the 8 FANG stocks were down with their PEs now at 44.3%. The PE of the S&P 500 is now approximately 16. It is valuable to look at each of the 8 FANGs individually to see what we can learn possibly of what's going on. I'll start with Apple, where I break down their lift we saw since the 2008 financial crisis, or what I will call here as the pre-COVID lift, which was about the new era of quantitative easing, or QE. I separate this from the lift we saw since the spring of 2020, when trillions of dollars were again pumped into the economies all around the world, approximately $29 trillion in total, to be exact. We see Apple had gone almost parabolic during this period, as shown by the black dotted line. We also see Apple followed the upper Bolmar band, which was recently curling at the top. Clearly, the biggest part of Apple's increases in value has appeared during the COVID rally. We also see the momentum, as shown in the lower pane, has begun to deteriorate. Moving to Microsoft, we see similar parabolic lift, mostly as a result of the COVID rally. Microsoft has experienced slightly more weakness in Q1 than Apple. Its parabolic lift has also curled, but price has not yet fallen to the Bolmar band mean. Momentum at the bottom continued to weaken, but may have found some temporary support. Moving to Google, we see again a similar parabolic lift, mostly as a result of the COVID rally. Google has had more of a drop during the first quarter of 2022 and has dropped to the center line of the Bowmar band. Again, momentum at the bottom has deteriorated. Tesla hasn't been around that long, but clearly almost all its gains have come during the COVID rally. Tesla went parabolic, but its upper Bowmar, which it tightly followed, has curled. Tesla's price, like the others, has fallen off in first quarter while experiencing significant volatility, as it is the darling of the gamma options players and has significant influence on both the Big 8 and the market overall. Its momentum is deteriorating quite significantly. Nvidia exploded during the COVID rally and actually went parabolic before falling off quite hard. Nvidia has dropped to its Bowmar band mean. Momentum is down but may have found support. Amazon exhibits similar characteristics as the others, but note that its price has fallen to touching its lower Bowmar band and in fact has broken through it. With momentum falling, it appears Amazon wants to give up all its COVID rally gains. Facebook has had a bad quarter with disappointing earnings and guidance. As such, Facebook has fallen to its lower Bowmar band and momentum has left the stock. Netflix was one of the major Q1 earnings news stories. It anticipates losing 2 million subscribers in Q2, and as a result, the stock was taken out behind the woodshed for a real beating. Netflix gave up all its COVID rally and then some. It broke through a Fibonacci 61.8% retracement of all its gains going back to the financial crisis lows. When we consolidate the 8 stocks together, the consolidated chart looks like this. The parabolic lift has topped, and the upper Bowmar band has rolled over and curled. We're now below the mean. It would appear we are headed towards the rising lower Bowmar band and a significant correction of all of the gains of the COVID rally. The same Big 8 stocks looked at differently shows a fairly orderly decline within the indicated channel. I highlighted here that the 20-week moving average in red is about to cross the 80-week moving average after having already crossed below the 40-week moving average. A cross of the 20-week moving average of the black 80 is likely to trigger a break of the channel to the downside. To put this all in perspective, this chart goes back to the late 70s. What stands out is the long red channel, which has contained price for decades, and also the black channel since the 2008 financial crisis. A test of the COVID lows only takes us to approximately the bottom of the black channel. It is our view that we will eventually touch the bottom of the red channel, and the Big 8 will be major casualties of this drop. The PEs will have experienced significant compression. In the 1970s, when we last saw inflation comparable to what we are witnessing today, we witnessed PE compression from 15 to 8, or approximately 50%. If the Big 8 fangs compressed by 50% to 22, they would still be well above historical standards of somewhere between 15 to 20. Presently, the longer-term adjusted PE, called CAPE, is hovering near 29, which is substantially above its long-term average of 15, or again twice as high. A 50% compression would bring it closer in line with historical averages. It is important to understand that the equity markets have not experienced what long-term investors know to be called capitulation. This is when people phone their brokers, no longer being able to stand further losses, and tell their broker to get them out of the market at any price. Just get me out. This will happen once again, but can be expected to be slightly different this time. Normally, this is triggered by excess margin and margin calls occurring. We clearly have historic use of margins, but this has been falling without capitulations. If you look at the bottom pane, you can see margin has been hit pretty hard, but still has potentially further to go. The damage has not yet fully happened. The real problem is that the markets have significantly shifted since the 2008 financial crisis with the adoption of passive investing through exchange-traded funds, or ETFs. ETFs are quite structured in what they will hold and in many cases track well-followed indexes, sectors, or investment themes. As a consequence, real selling comes with what is referred to as redemptions. This is when a holder exits and wants their money back. Today, to get that money, all it takes is a simple keystroke to sell an ETF online from your brokerage house. This would force the liquidation of a large set of stocks held within the ETF to be sold. If only a few million people start hitting the sell key at the same time, The liquidity, or the lack of it, would literally implode the ETF and equity markets overall. This concern is well documented and has been noted for a long period of time. We're very close to that happening. Redemptions are only now beginning to happen. This will trigger capitulation, and a whole generation of investors will learn lessons others learned during the financial crisis crash. Liquidity to sell a stock can disappear faster than the thief in the night. What might we learn from all this? We are at the end of one of the longest business cycles in history, and a recession is likely, which will further compound the problem of stagflation. Stagflation means higher inflation and slower growth. Both have profound impact on PE compressions. PEs are relative not just to earnings, but to the perception of growth and inflation. Both are changing in ways not seen since the last financial crisis. The Fed is on course to raise rates and reduce its balance sheets. This will remove the pillar that has been artificially driving the market since the last financial crisis and can only hurt stocks. As I always remind you in these videos, remember, politicians and central banks will print the money to solve any and all problems until such time as no one will take the money or it is of no value. That day is still in the future, so take advantage of the opportunities that currently exist. Investing is always easier when you know with relative certainty how the powers to be will react. Your chances of success go up dramatically. The powers to be are now effectively trapped by policies of fiat currencies, unsound money, political polarization, and global policy paralysis overall. I'd like to take a moment as a reminder, do not trade from any of these slides. They're for educational and discussion purposes only. As negative as these comments often are, there has seldom been a better time for investing. However, it requires careful analysis and not following what has been traditionally the true and tried approaches. Do your reading. Make sure you have a knowledgeable and well-informed financial advisor. So until we talk again, may 2022 turn out to be an outstanding investment year for you and your family. And I sincerely thank you for listening.